seem willing to do something to counter a slowdown. And we are in the midst of realizing that they can be willing and able to move, but they're not going to deliver effectiveness. And that's the tug of war in our investment committee. The market right now is dominated by traders as opposed to investors. And traders look at such high-frequency elements and are in a trade for as long as it's moving. The minute it stops moving, they're out of this trade quickly, and understandably so. The problem is this is happening in the context where risk appetites are low, where the final investor has been exiting, and where the investment banks have very little capacity to warehouse risk. And that's why we get these risk on, risk off, even in the same day, with relatively little information. Carefully to Bernanke, if you listen carefully to what Mario Draghi at the European Central Bank has been saying, you come to the conclusions that policymakers and markets are not in the same place. Policymakers are saying, look, we're willing to move if we have to, but be careful, because it's not clear that we can be totally effective. That's why Bernanke told the Congress today, I would like to shift the burden to you, Congress, because there's a limit to what the Fed can do. Markets aren't there yet. Markets aren't unbundling willingness, ability, and effectiveness. So they react immediately to anything. Russia is slowing, and the US is slowing. So we are in this synchronized slowdown. What investors have to ask is, will this tip us into financial instability as well? And that's particularly important for Europe. But I think that we have to navigate a slowing, and we also have to navigate the policy response that that's going to trigger.
And so how do you want to invest in this environment then?
So we know that if the economy continues to slow, it will probably trigger a central bank reaction. So you want to be looking at what central banks are going to be focusing on in terms of what they influence directly. If you're going to go further out to high-yield bonds and equities, you're making a bet not just on central banks acting, but on central bank delivering outcomes. So this is a world for up-in-quality trades, highly differentiated, and retain optionality, because the market will give you occasion after occasion to pick up good stocks at low prices.
So
much a mess and not getting any better, and because we are slowing. When do they pull the trigger is the question mark. And that's going to depend on how much risk are they willing to take with a further slowdown. But every day that Europe deteriorates further and we slow, the probability of QE3 goes up.
All right, we'll leave it there. Mohammed, great